Welcome back to the deep dive. You know that feeling, right? Staring at a tax form and it just looks like, well, like it's written in another language entirely.
Absolutely. Some of them feel intentionally obscure, almost like a test.
Exactly, like a puzzle you didn't ask for.
Uh,
Well, today, grab your coffee, maybe something stronger, because we are diving headfirst into one of the big ones, one that trips a lot of people up, Form 3520A.
it's a significant one. Foreign trusts, reporting requirements. It can feel like a maze, honestly. And the stakes are high if you get lost.
That's why we're here. This deep dive, it's all about unpacking Form 3520A, the annual information return of foreign trust with a U.S. owner. We're not just going to read the lines. We're going to figure out what they mean, why they matter.
And we'll explore how getting this right, just being diligent, is actually a huge tax-saving move.
Yes, not in the way you normally think, like finding deductions, but by avoiding these massive, potentially crippling penalties. It's like preventative medicine for your finances.
Exactly. Avoiding a huge problem is often way better than trying to fix it later. So yeah, let's get into it.
Okay, let's start at square one. What is Form 3520-A, fundamentally? What's its job?
Right. So first off, it's not a tax payment form. You don't send money with this one. It's purely an information return.
Information for the IRS.
Precisely. It's specifically for foreign trusts that have at least one U.S. owner. The whole idea is to give the IRS visibility, a window into what these foreign entities are doing financially.
So they know what's happening offshore.
Uh-huh. It falls under Section 6048B of the tax code. For a U.S. person who's considered an owner of a foreign trust, this form is how they meet their annual reporting duty. Think of it like a really detailed financial report card for that trust, made just for the IRS.
A report card. I like that. So if it's the trust report card who's turning it in, the trust itself, maybe some trustee overseas.
Okay, this is where it gets tricky and really important for you, the listener, if you're a U.S. owner. Primarily, yes, the foreign trust is technically responsible for filing Form 3520-A.
But there's a catch, I'm guessing.
There's a big catch. Even though the trust is supposed to file, every single U.S. person who's treated as an owner of that trust has a direct responsibility. They have to make sure the trust files the form.
Make sure. So you can't just like set it and forget it.
Right.
Assume the foreign trustee's handling it.
Absolutely not. That's a dangerous assumption. You, the U.S. owner, have to be active. You have to ensure the trust files, and you have to ensure the trust provides the required statements. We'll get to those to the U.S. owners and any U.S. beneficiaries.
So the responsibility ultimately lands back on the U.S. owner, even if the trust is physically located and managed somewhere else entirely.
That's exactly right. No passive delegation. The IRS views it as your responsibility to oversee this. If that foreign trust doesn't file, maybe they're negligent. Maybe they just don't understand U.S. rules. Maybe the foreign trustee is just being difficult.
Which can happen?
Right, which definitely can happen. If they fail to file, the U.S. owner must step in.
Okay, so what does stepping in look like? Is there a backup plan? A way for the U.S. owner to fix it?
There is. It's a sort of safety net, but you have to use it correctly. If the foreign trust drops the ball, the U.S. owner must file what's called a substitute form 3520A.
A substitute form.
Okay.
Did you just fill it out and send it in?
Not quite.
Yeah.
You have to physically attach this substitute Form 3520A to your own Form 3520. That's the annual return to report transactions with foreign trusts and receipt of certain foreign gifts. They're linked.
Ah, so it becomes part of your personal reporting package to the IRS. That makes
Yeah.
sense. What about timing? Deadlines?
Crucial point. And a common trap. The due date for the substitute 3520A is the same as your Form 3520 due day. So for most individuals, that's April 15th or October 15th if you file an extension for your personal return.
Okay, and how is that different from the trust's original deadline?
The foreign trust's original deadline for Form 3520A is usually earlier. It's typically the 15th day of the third month after the trust's tax year ends. So for a calendar year trust, that's March 15th.
March 15th versus April 15th, or even October 15th. That's a big difference.
Yep.
Mixing those up could be bad.
Extremely bad. Missing that deadline distinction, even accidentally, can lead directly to penalties. And that brings us to the stakes involved.
Right, the penalties. This is where the tax saving comes in. By avoiding them, I've heard they're not small.
Not small is an understatement. They can be absolutely brutal. Honestly, understanding these penalties is probably the single best motivator for getting Form 3520A right.
So what are we talking about if the trust fails to file or files late or gets it wrong?
Okay, the initial penalty the U.S. owner faces is the greater of two amounts, either $10,000 flat out or 5% of the gross value of the portion of the trust's assets you're treated as owning at the end of that tax year.
The greater of 10K or 5% of the assets. Let's run some numbers. Say the trust has $200,000 in assets you own. 5% is $10,000. So the penalty is $10,000.
Right, hits the minimum.
But if the trust is bigger, say $500,000, 5% of that is $25,000. So the penalty jumps to $25K.
Exactly. And if it's $1 million trust portion, that's a $50,000 penalty. These are significant hits designed to make people pay attention.
And that's just the initial penalty. It can get worse.
Oh, yes. If the non-compliance continues for more than 90 days after the IRS sends you a notice about it, they can tack on additional penalties. It keeps adding up.
Wow. Is it just financial penalties, or could it get more serious? Criminal charges.
It can escalate. The form instructions do mention potential criminal penalties under sections like 7203, 7206, 7207 for willful failure to file or filing fraudulent returns.
So intent matters.
Intent definitely matters. Plus, if you underpay your actual income tax because of unreported foreign trust income or assets, the regular underpayment penalty under Section 6662 can get increased specifically because it relates to foreign assets. That's Section 6662J. The IRS has multiple ways to hammer this home.
They really layer it on. Okay, is there any way out? What about reasonable cause? Can you argue you had a good reason for not filing?
There is a reasonable cause exception, but let's just say the IRS interprets it very narrowly. They're very clear about what does not count.
Like what? What excuses won't fly?
For example, arguing that a foreign country penalizes you for disclosing the info the IRS wants. Not reasonable cause.
So caught between a rock and a hard place doesn't count.
Nope. Or if your foreign trustee simply refuses to give you the information, still not reasonable cause in the IRS's eyes. Even if the trust document itself forbids disclosure, still not reasonable cause.
That's incredibly strict. It basically puts all the onus on the U.S. owner to overcome any obstacle, foreign laws, uncooperative trustees, anything.
That's exactly the message. The burden is squarely on you, the U.S. owner, to ensure compliance, period. You need to anticipate these issues, structure things correctly, maybe choose your trustee very carefully. It's all part of the due diligence the IRS expects.
So bottom line, the most significant tax saving connected to Form 3520A is simply avoiding these massive penalties through diligent, accurate, timely filing. Prevention is the cure.
Absolutely. That $10,000, $25,000, $50,000 you don't pay in penalties, that's real money saved, directly protecting your assets. It's proactive financial defense.
Okay, that sets the stage. Before we walk through the form line by line, we absolutely need to get the definition straight. The IRS has its own dictionary sometimes, right?
Oh, for sure. And these definitions are often deliberately broad to capture all sorts of arrangements. Understanding their specific meaning is crucial for getting the form right.
Let's start with the big one. Foreign trust versus domestic trust. It sounds simple. Where was it set up? But I bet it's more complicated.
You're right. It's not just about geography. It's a two-part test. A trust is domestic only if, 1, a U.S. court can exercise primary supervision over its administration. That's the court test. And 2, one or more U.S. persons have the authority to control all substantial decisions of the trust. That's the control test.
But both have to be met.
Both. If it fails, either the court test or the control test, even just one of them, it's automatically classified as a foreign trust for U.S. tax purposes.
So a trust set up in, say, Delaware, but with the foreign person controlling the key decisions, could actually be a foreign trust.
Exactly. That's a classic example. Or a trust set up offshore, even if it has U.S. beneficiaries or a U.S. trustee handling minor things, if the substantial decisions aren't controlled by U.S. persons, it's foreign.
Okay, that's clear. Next up, grantor trust versus non-grantor trust. Why does this distinction matter for 3520A?
It matters hugely because Form 3520A is specifically for foreign trusts with a U.S. owner, and that U.S. owner status usually arises under the grantor trust rules found in Sections 671 to 679 of the Code.
So what is a grantor trust?
In simple terms, it's a trust where, for income tax purposes, the trust's assets are treated as owned by someone other than the trust entity itself, usually the person who created or funded it, the grantor. This means the income, deductions, credits, everything generated by the trust's assets basically flows through onto that owner's personal tax return.
Like it doesn't exist as a separate taxpayer.
Pretty much. A non-grantor trust, on the other hand, is treated as a separate taxable entity. The trust itself pays tax on its income.
And Form 3520A is mainly concerned with the grantor type, where income flows through to a U.S. owner.
That's the primary focus. Although, it's worth noting, a trust can actually be partly grantor and partly non-grantor, which adds another layer of fun.
Oh, joy. Okay, who is a grantor then? Just the person who set up the trust?
Generally, yes. Anyone who creates a trust or makes a gratuitous transfer, basically a gift of cash or property to a trust. But like everything else, it gets more complex.
How so?
Well, what if a partnership or a corporation funds a trust? Generally, the partners or shareholders are treated as the grantors unless it was done for a clear business purpose of the entity itself.
Okay, looking through the entity.
Right. And if one trust transfers assets to another trust, the grantor of the first trust is usually considered the grantor of the second trust. It follows the money's origin. There's an exception if someone uses a general power of appointment over the first trust to direct funds to the second, then that person becomes the grantor of the second trust.
So they're always trying to trace it back to the individual who ultimately provided the value.
Yeah.
Makes sense. And the owner.
The owner is simply the person who is treated as owning any of the foreign trust's assets under those grantor trust rules we just talked about. They're the one the income flows to.
Got it. Now, distribution.
Mm.
This sounds like money paid out. But based on our conversation so far, I'm guessing the IRS definition is much wider.
You are learning. Yes, distribution is incredibly broad. It's not just a check written from the trust. It's any gratuitous transfer of money or property from the foreign trust. Doesn't matter if the recipient is officially a beneficiary or not. It includes receiving trust principal, gifts, bequests.
Okay, that seems fairly standard. But you said broader.
Ah, yes, the constructive transfers. This is where it gets really interesting. The IRS considers many things a distribution, even if no cash changes hands directly.
Constructive transfers, like what? Give me some examples.
Okay, classic examples from the instructions. If the foreign trust pays your personal credit card bills, that's a distribution to you. If you get a loan from the trust at 0 interest or below market interest and don't repay it promptly, that can be treated as a distribution.
Using trust assets without paying fair price.
Exactly. If you get to use trust property like live in a house owned by the trust without paying fair market value rent, that use value is a distribution. Or so you sell stock worth $100 to the trust, but they pay you $150. That extra $50 is a distribution from the trust to you.
Even selling something to the trust can trigger a distribution from it if the price isn't right.
Wow. Yep. Or if you do work for the trust worth $20, but they pay you $100, that $80 difference is a distribution. They're looking for any way value moves from the trust to a U.S. person without fair exchange.
It really prevents disguised payments or benefits. They've thought of a lot of scenarios.
They certainly have. The goal is to capture the true economic benefit flowing out.
Okay, moving on. U.S. agent. What's this role about? Sounds like the IRS wants someone local they can talk to.
That's precisely it. A U.S. agent is a U.S. person could be an individual or a company who has a formal binding agreement with the foreign trust. They agree to act as the trust's agent specifically for IRS requests.
Requests like what?
Examining the trust's books and records, providing testimony, responding to summonses related to the trust's U.S. tax treatment, basically being the IRS's point of contact in the U.S.
And who can be this agent?
It can be a U.S. grantor, a U.S. beneficiary, or a domestic corporation that's controlled by the grantor or beneficiary. The key is they have to be a U.S. person subject to U.S. jurisdiction.
And why is having one so important? What happens if a foreign trust doesn't appoint a U.S. agent?
This is a huge leverage point for the IRS. If a foreign trust with a U.S. owner doesn't have a U.S. agent, the IRS has the authority to basically determine the amounts related to the trust that the U.S. owner has to report unilaterally.
Meaning the IRS can just decide what the income is, what the distributions are, without necessarily seeing the trust's actual records.
Essentially, yes. They can make their own determinations. And the burden would be on the taxpayer to prove them wrong, which can be very difficult without cooperation. Having a U.S. agent provides that channel for information and avoids the IRS making potentially unfavorable assumptions. It's a strong incentive to appoint one.
Definitely sounds like it. Okay, next definition. U.S. beneficiary. Again, bracing for a wide net here.
Good instinct. It is extremely broad. It's basically any U.S. person who could possibly benefit from the trust, directly or indirectly at any time.
Could possibly benefit, even if they're not named, even if it's conditional.
Yes. Even if their interest is contingent on some future event or they can't actually receive anything in the current year. If there's a possibility, however remote, that they could benefit down the line, they might be considered a U.S. beneficiary.
That's vast. Does it include entities, too?
It does. Things like controlled foreign corporations, CFCs, form partnerships with U.S. partners, even other foreign trusts or estates if they have a U.S. beneficiary. But the real kicker is the presumption rule.
Presumption. What gets presumed?
If a U.S. person transfers property to a foreign trust, The IRS presumes that trust has a U.S. beneficiary, unless the trust document meets very strict requirements.
What requirements?
The trust instrument has to explicitly prohibit any distribution of income or principal to any U.S. person ever. Not just now, but at any time, even after the trust terminates or the transferor dies. And crucially, the trust terms cannot be amended later to allow distributions to a U.S. person.
So if the trust document gives the trustee any discretion about distributions and doesn't explicitly forbid U.S. beneficiaries forever, the IRS assumes there is one.
That's the practical effect. Generic clauses giving trustees discretion often trigger this presumption, and it goes further. Any side deals, any unwritten understandings that could benefit a U.S. person, they're treated as terms of the trust.
Wow. No wiggle room.
Very little. And again, those constructive distributions we talked about, below market loans, uncompensated use of property can also cause a trust to be treated as having a U.S. beneficiary, even if the documents say otherwise.
They really cover all the angles. Lastly, U.S. person. Quick definition.
Broadly, it's a U.S. citizen or resident alien, a domestic partnership, a domestic corporation, or a domestic estate or trust. Pretty much any person or entity with a clear U.S. tie.
Okay, definitions conquered. Now let's get practical. Let's walk through Form 3528 itself, applying all this knowledge, section by section, line by line. This is where the rubber meets the road for compliance and that tax saving through penalty avoidance.
Sounds good. Let's start right at the top with the general instructions before Part 1. Simple stuff, but crucial to get right.
First, period covered. Calendar year or fiscal year?
You just indicate which one applies. Calendar year, just enter the year. Fiscal year, enter the specific beginning and ending dates of the trust's tax year.
Then there are those check boxes. Initial, final, amended, extension filed. Seems straightforward. But then there's that really important one. Substitute Form 3520A.
Right. That's the box the U.S. owner checks when they are filing this form because the foreign trust failed to do so, and they're attaching it to their own Form 3520. It flags the situation for the IRS.
Got it. There's also one for accepted specified foreign financial assets reported. What's that linked to?
That connects to Form 8938 reporting. If assets reported here are exempt from 8938 because they're properly reported on 3520A, you check this box. It helps the IRS cross-reference.
Okay, moving into Part 1. General information. The trust's ID card. Lines 1A to 1AS, name, address, EIN.
Crucial details. Make sure the name is exact, the address is complete. And very important, use the trust's employer identification number, EIN, not a social security number or ITIN. Getting these basics wrong can cause processing nightmares.
Then line 2, the big question. Did the foreign trust appoint a U.S. agent? Yes or no? We know why this matters.
Hugely. If yes, you have to enter the year. The actual authorization of agent document was last attached to the form. Remember, that needs to be refreshed every 3 years or if the agent changes.
And if the answer is no,
then brace yourself. If there's no U.S. agent, you must attach copies of basically all the trust's governing documents.
all of them. Like what?
The instructions list, a summary of any written or oral agreements, the actual trust instrument, any letters of wishes or similar side documents, any amendments or variations, and a full organizational chart showing the trust's structure and ownership.
That's a mountain of paperwork. What if you filed them last year?
There's a small break. If they were attached within the last 3 years, you only need to attach relevant updates. But the first time, or after 3 years, it's the full load. It's a strong incentive to just appoint the agent.
Definitely seems that way. If yes to the agent, lines 3A to 3G are for the agent's details name, TIN, address.
Right, providing the IRS with the direct contact information they need.
Lines 4A to 4G ask for the trustee's details name, TIN, if they have one, address.
Standard identification for the fiduciary running the trust.
Then lines 5 and 6 ask for account how many foreign grantor, trust owner statements, and beneficiary statements are attached. This points to those separate documents we mentioned.
Yes, highlighting that 3520A is often a package, not just the main form. Those statements are key communication pieces.
And finally, the signature. Who signs?
Normally, the trustee of the foreign trust signs. But big but, if it's a substitute form filed by the U.S. owner, then the U.S. owner signs it and puts their own name and TIN in the title line, clearly showing who is taking responsibility for this filing.
Makes sense. Okay, that's part I down. Now for the meat. Part 2, the foreign trust income statement. This is where the money flows, where the tax impact happens for the U.S. owner. What's the guiding principle here? What accounting rules apply?
The main principle, report all income, U.S. and foreign sources, And critically, the statement needs to reflect the trust's income according to U.S. income tax principles. Not foreign accounting rules, not necessarily GAAP, but U.S. tax rules. This might require adjustments and translations.
Okay, let's walk through the income lines. Line 1, interest. What goes here?
All taxable interest, bank accounts, CDs, notes, bonds, U.S. treasuries, even OID, original issue discount. One nuance. If you have amortizable bond premium on taxable bonds, that reduces the interest reported here directly. It's not a separate deduction.
Got it. Line 2, dividends, just regular dividends.
Ordinary dividends, yes. Important to separate these from capital gain distributions, which go on line 5 because they're taxed differently.
Line 3, gross rents and royalties. Seems clear. Line 4, income loss from partnerships and fiduciaries. What's this covering?
This is flow-through income. If the trust owns an interest in a partnership, an S-corp, another trust, an estate, a REMAC, its share of the income or loss from those entities gets reported here. Think Schedule K1 income flowing to the trust.
Okay, so K1s received by the trust feed into this line. Then line 5, capital gains losses, and line 6, ordinary gains losses. Why the split?
Same reason as on an individual return. Capital gains from selling capital assets often get preferential tax rates, while ordinary gains from non-capital assets or involuntary conversions are taxed at regular rates. For the U.S. owner receiving this flow-through income, this classification is vital for their own tax calculation. Line 5, gains losses would generally inform their Schedule D.
Right, maintaining the character of the income. Line 7, other income. The catch-all.
Yep, anything that doesn't fit neatly elsewhere. Maybe a lump sum distribution reported on a 1099-R, for example. If you have items here, you need to attach a statement explaining what they are. Line 8 is just the total income.
Okay, income side done. Now, expenses, lines 9 through 15. These reduce the net income that flows through, so getting them right is key to accurately reporting the taxable base for the U.S. owner. Line 9, interest expense.
This is interest the trust paid on money it borrowed. Big caveat, no deduction for interest on debt used to buy or carry tax-exempt investments. You can't deduct interest to generate tax-free income. Also, complex rules apply if loan proceeds are used for multiple purposes.
Line 10A, foreign taxes, and 10B, state and local taxes. Are all taxes deductible?
No, definitely not. 10A is for foreign income taxes paid by the trust. 10B is for state and local income or real property taxes. Key exclusions: no deduction for U.S. federal income tax, federal estate or gift taxes, or federal excise taxes.
Makes sense. Line 11, amortization and depletion. Standard stuff for business income property.
Yes, for assets used in a trade or business or held for income production, you use U.S. depreciation rules and methods, which might differ from foreign rules.
Line 12, trustee and advisor fees for managing the trust.
Generally deductible, yes. Fees paid to the trustee or advisor's legal, accounting, investment for administering the trust.
Line 13, charitable contributions. Any quirks for foreign trusts, like does the charity have to be a U.S. charity?
Interestingly, no. The deduction is generally allowed if the contribution is paid for a purpose specified in the U.S. tax code, Section 170C, but the organization itself doesn't have to be created or organized in the U.S.
That's good flexibility. Line 14, other expenses. Another catch-all needs a statement if used. Line 15, total expenses, which leads us to
Line 16, net income loss. This is the bottom line from the trust operations calculated under U.S. tax principles. This is the amount or loss that's generally attributable to the U.S. owner under the grantor trust rules. Its accuracy is paramount.
absolutely critical number. Now, distributions, line 17. Line 17A is fair market value of total distributions, and it requires a statement. What's on it?
This statement is incredibly detailed. It asks for recipient's name, TIN, country, description of the property transferred, FMV basis, description of the transfer itself and any related transactions, any consideration the trust received, if no consideration, details about control over the recipient, description of any subsequent transfers of that property, and a full ownership structure org chart for the trust.
Oh, they want the whole life cycle of the distribution and everyone involved.
Pretty much total transparency on where the value went.
Then lines 17B and 17C break out the distributions specifically to U.S. owners and U.S. beneficiaries. What info is needed there?
For each U.S. person receiving a distribution, actual or constructive, you need their name, USTIN, the date of the distribution, and the fair market value on that date. And crucially, you need to prepare those separate owner or beneficiary statements for each recipient and furnish it to them.
Connecting back to those statements. Okay, that wraps part 2. Let's move to part 3, the foreign trust balance sheet. What's its main purpose?
It's a snapshot of the trust's financial position, assets, and liabilities at the beginning and end of the tax year. It includes all assets and liabilities, not just the portion owned by the U.S. person. Valuation is at fair market value. It helps the IRS gauge the trust's size, scope, and changes year over year.
What kind of assets are listed?
Standard categories: cash, including CDs, receivables, accounts, mortgages, notes, inventories, government obligations, marketable securities, non-marketable securities, depreciable assets, net of depreciation, real property, and other assets. Needs a statement. Very comprehensive.
And liabilities.
Accounts payable, contributions, gifts payable, mortgages, notes payable, other liabilities. Needs a statement.
Then it calculates net worth, broken down into contributions, accumulated income, and other. One helpful point: you mentioned no book-to-tax reconciliation is needed here.
Correct. That specific reconciliation isn't required for this Part 3 balance sheet, simplifying it slightly. The accumulated trust income line is important, though, showing retained earnings potentially available for future distribution.
Good to know. Now let's revisit those vital owner and beneficiary statements, pages 3 to 5. They get attached here. A&D sent to the individuals. What's the timing?
Yes, attached to the 3520A and furnished to the U.S. person by the 15th day of the third month after the trust's year-end, March 15th for calendar year. The deadline extends if the 3520A filing is extended or if it's a substitute form. Getting these statements to the individuals on time is critical for their filing obligations.
What's on the owner's statement that the U.S. owner needs?
It summarizes everything for them: trust info, owner info, gross value of assets owned, and then the core, the statement of foreign trust income attributable to U.S. owner. This breaks down their specific share of interest, dividends, rents, K-1 income, gains, losses, other income, and the related deductible expenses. It gives them the numbers they need to plug into their own 1040.
So it translates the trust's Part 2 into the owner's personal share and the beneficiary statement.
Similar identifying info, but its main job is to report the fair market value of all distributions, actual and constructive, received by that specific U.S. beneficiary during the year. This gives the beneficiary the info they need for their Form 3520 reporting.
Got it. This whole process, line by line, statement by statement, really emphasizes the need for meticulous record keeping and attention to detail.
Absolutely. Every piece feeds into the IRS's picture, and accuracy everywhere is key to that tax saving through compliance and penalty avoidance. It's definitely not a simple form.
Okay, let's pull back and synthesize. After diving deep into Form 3520A, what are the absolute must-remember takeaways for our listeners?
Well, first, the core purpose: transparency. Form 3520A is the IRS's tool for understanding foreign trust with U.S. owners, their structure, finances, and distributions.
And the big tax-saving theme we've hit on.
It's not about finding loopholes on the form. It's about the meticulous, accurate, timely filing of the form to avoid those crushing penalties, the $10 or 5% minimum, plus potential add-ons. Getting Part 2 right, reflecting the correct income and expenses under U.S. tax rules, ensures the U.S. owner reports the right amount on their return, avoiding underpayment penalties too. Compliance is the saving.
And importantly, this form isn't an island. It lives in an ecosystem of other form recording rules.
Critically important point: Form 3520A often travels with companions. There's Form 3520 for the U.S. person's transactions. There's the FBR, FinCEN Form 114 for foreign bank and financial accounts filed with Treasury, not the IRS. And there's Form 8938 for reporting specified foreign financial assets over certain thresholds.
So one foreign trust could easily trigger reporting on 3520A, FBIR, and 8938, depending on its assets and structure.
Easily. A trust holding foreign stocks and a foreign bank account. Bingo, you could be looking at all three, each with its own rules and penalties. You have to assess each requirement independently.
What about those exemptions we touched on? Certain Canadian retirement plans, RRS, PSRIFs, via Rev Proc 2014-55, or other tax-favored foreign trusts, Rev Proc 2020-17, might be exempt from 3520A. Does that get you off the hook for FBAR too?
The million-dollar question and a huge trap. No, absolutely not. An exemption from Form 3520-3520A reporting under those revenue procedures does not exempt you from FBAR or Form 8938 reporting if you meet their separate requirements. People get tripped up on this all the time. Check each form's rules independently.
That is a vital clarification, so staying current is essential.
Non-negotiable. Check the latest IRS instructions, publications like Pub 519, and those revenue procedures. International tax is a moving target.
And finally, that practicality point, the sheer time involved. You mentioned the IRS estimate for just record keeping for 3520A.
Yeah, it's kind of mind-blowing. The official estimate is 37 hours and 18 minutes on average just for the record keeping needed to support this one form.
37 hours. That really drives home the need for organized, continuous record keeping all year long, not something you can piece together on April 14th.
Exactly. Track the income, the expenses, the distributions, the asset values, the trustee communications. It's an ongoing process. But when you weigh 37 hours against a potential $10,000, $25,000, or higher penalty, the time investment makes a lot of sense.
It really frames compliance as the most cost-effective strategy in the long run. Proactive diligence is the shield.
Well said. Foresight beats penalties every time.
So as we wrap up, here's something to chew on. Understanding Form 3520A is a window into how interconnected global finance is and how seriously the IRS takes tracking cross-border money. It makes you wonder, what other, maybe less obvious, foreign arrangements or assets might have their own reporting rules lurking beneath the surface, rules that could affect your financial situation. Diligence across the board is key.
Definitely take a moment to review your own situation. Do you have foreign accounts, investments, entities, inheritances, trusts? If anything we discussed today sparked a question or a doubt, please talk to a qualified international tax professional. Getting ahead of these things is always the best approach.
We really hope this deep dive has shed some light on the complexities of Form 3520A and driven home why getting it right matters so much. Thanks for tuning in, and until next time, keep digging deeper.